Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Welcome back to another episode of the Real Estate Investing Club. Today we have a twofer for you guys. I know you love these. We got two guests with us, Peter Neal and Ron Lockhart from way over there in Philly. They are with GSP Real Estate and they do single family. I know everybody loves single family. It's definitely the asset class that has the most number of units out there. So I'm super excited about this. Peter, Ron, thank you guys very much for hopping on the show.
Thank you for having us.
Yeah, thanks for having us, Gabe.
Absolutely. I told you before we got on here, we like to start with stories. We're going to have to take some turns, do some dancing here, so you guys can go between them. So take us back to the beginning of both of your guys' stories. How did you get started in real estate?
Sure. Ron, you want to kick it off, and then I'll go.
Yeah, I'll give you the 35,000 foot view so we can get through this. I got started about 25 years ago on the construction side of the business. Very quickly migrated to real estate investment. I've been a partner in a real estate finance company that did both commercial and residential real estate finance, consulting. Have touched pretty much just about every facet of the real estate investing world that you can think of. But the one consistent has always been the investment side of the business. And at the core of it, it was always the single family market. So that's the short version.
Nice. I like it. Easy.
Yeah. So my introduction to real estate was through my dad. He was a facilities manager at CBRE. And I always thought I never want to work in real estate. I could still remember times when he was up at 2-3 o'clock in the morning, if it was snowing or a storm or something like that. And it was after college that I was looking for a job, took a job doing marketing for a real estate investment company. And the CEO did a lot of personal real estate investing in the single family side, and the company focused on distressed mortgages. So I saw a totally different facet of the business, and I was raising capital for their fund, so meeting a lot of different investors who've done a lot of different things. And one thing led to another, and Brian and I started GSP a couple years ago, and that's kind of where we are today.
Nice. I love it. And one thing led to another. I feel like that's how most of our stories end up, is just we start one thing and then it leads to another, and eventually we're in real estate.
Sure.
Awesome. I love it. So it sounds like you both have tons of experience in real estate. You're veterans at this point, which I love to see. Single family is what a lot of people get started in, and then they move on to other things. But I love to see people that just stay in single family because there's so much volume out there. There's so much that you can still do. Why did you guys, most people move on to multifamily. Why did you choose single family as, your bread and butter, your business model?
So going back to how I got into real estate, starting on the construction side of the business, we had for many years a new home construction company. We were new home builders. So at the core of everything we've done over time, even as we migrated to the investment side, was construction was a core component of what we did. And the teams we developed over the years really were more of a single family, 1 to 4 unit multifamily. That was as big as we would go 4 unit from a construction process. So that was really our comfort zone and our sweet spot. Years later, I got involved with government services entities through the National Community Stabilization Trust. We were a development services partner of theirs. So we got a lot of single family assets through HUD programs. And, so that really just became, whether we were renovating to sell, renovating to hold, it just was at the core of everything that we did. And I'm a big believer in, when you find something that works, you kind of stay in your lanes. And, if you can, and scale was obviously an opportunity, and that's what we decided to focus on. And we like what we do. We feel like we're very good at it, and it fits our structure.
Yeah. Yeah, that I feel like that is the thing that gets most people tripped up in real estate when they see those shiny objects and they just want to jump from lane to lane to lane to do this, do that, do self-storage, do single family, do multifamily. But if you stay in one lane and you get really good at it, that's where the true magic happens. So a lot of reasons people move on from single family is that they find it is difficult to scale. They buy one, they buy two, up to 10 or something like that. And then they realize it's just too much. I'd rather buy just one multifamily apartment building with 20 units, whatever. So scaling is really the thing that holds a lot of people up. How did you guys scale your single family business?
Peter, you want to
Yeah,
talk
well,
about that?
yeah, well, it's funny because I think I think that is kind of one of the misconceptions. Well, I understand why people feel that way and probably do experience that in some case. But at the same time, I think scale in single family is just as important as scale in multifamily. There's economies of scale created the larger the portfolio is. And you have more of an opportunity to make some key in-house hires if you want to go that route, or the larger you are, the better opportunity you have to maybe work with a strong third-party property manager. So I think depending on the way you look at it, scale and single family can create a lot of efficiencies. So that's one thing, for us. And one thing, like my background in raising capital and looking for a viable strategy that we could do for long term, single family was something that I thought would make a lot of sense because there's a huge demand for single family, especially in the workforce affordable side of the business that we do. So with a huge demand, if you're in the right areas and you can buy right, then you can scale. I mean, but I certainly understand that there are people in certain areas, if they're restrained to only wanting to work in their market or something like that, and they don't want to get into other areas, then it might find it challenging to find deals that make sense. Fortunately for us, we're outside of Philadelphia. We invest in Baltimore. We invest in certain parts of South Jersey. We have a number of other areas that are close to us that we also have identified that we like, but it comes back to that scale. I mean, the couple markets that we're in that we're focusing on, we really want to get to a certain amount of units in those areas to just create more and more efficiencies. So I don't know, Ron, if you have anything to kind of add to that, especially on like the vertical integration, because one thing that makes us be able to do what we do is having the property management, the construction in-house.
No, I think you hit the nail on the head. And, it goes back to what I was saying earlier that, we've built a business and a structure that works for us, that we feel comfortable with. And where a lot of people would look at it and say, scaling in the single family space is a headache. We don't look at it that way. I mean, we like, it's not, we can do one door at a time. We buy portfolios, renovate portfolios. So again, we're just set up to do this. We've been doing it for a long time, and we feel very comfortable with it.
Yeah. So you've already mentioned you guys are in multiple markets. You're not just in Philadelphia. When you go into a new market, well, first tell us, which markets are you in? How many markets are you in?
God.
Yeah, so primarily Baltimore right now is a large focus for us. We can find consistent deals that fit our model, especially on the distress side, where we can go in. We're not competing with regular home buyers or something like that. We're buying distressed product that we're going to add a lot of value to, essentially redevelop and hand over practically new construction to our tenants. And then Philadelphia, obviously that's, we still look in Philadelphia. We occasionally buy in Philadelphia. It's a little harder over the years to find good deals there. And there's certain parts of South Jersey that we like, but it's the same thing. It's not really a place that we specifically look at for deals, but if they come by and they make sense and they're close to other properties we own, we certainly will take a look at them.
Yeah. So when you do go into do a new metro, like when you first went into Baltimore, how did you spin up the metro? Do you have a certain number of units that you need to have in a specific metro to make it make sense, to make it scalable? What are your criteria when you're going into a new metro?
So first and foremost, there has to be demand. And that's the first thing we look at. I mean, we researched Baltimore for the better part of a year before we bought a single door. We look at it as, we don't want to just buy 20, 30 properties. We want to have no, we're not saying we're going to buy 1,000 properties, but we want to be in the hundreds, not, not 10, 20, 30, 40. For the market to really make sense for us. Because as Peter pointed out, being in Pennsylvania, New Jersey, and Maryland, we're able to look, touch, and feel all those markets. We can send our own teams there. We're not relying on third parties. And the demand is so high in those markets, you could buy 10,000 doors and you're still not scratching the surface of the demand issue.
Yeah. So
to kind of add to that too, Gabe, so a couple of things that we'll look for going into a new market. We like to be in that workforce, so middle income, where we'll have an option where we don't only have to rent the Section 8 tenants, but there is an option to rent to either, middle income tenants who make too much to qualify for those subsidies. But we also have the option to lease to Section 8 tenants as well, because we do like a certain percentage of Section 8 to non-Section 8. Another part of it is looking for value generators. Like Ron said, we want to see demand for the type of product that we're bringing to market. Affordable housing, workforce housing type units, and then we want to be close to transportation, value generators like hospitals or universities, or close to business districts, but maybe not too close, that kind of thing. So. There's certain, and then like crime and too, like, is there a strong retail? Is there a strong sales market beyond just investors, or is it only investors buying in the area? We'd prefer to be in an area where there's also a market for regular home buyers as well. Especially if we're buying distressed property, we can choose to keep the property and rent it, or we can resell it to a regular home buyer and not another investor.
Yeah. Having multiple exit strategies is super important. So we're throwing out some big numbers there in terms of the number of units you want in a metro to make it make sense, which means that you got to find all those properties. How do you guys go about, sourcing your leads, sourcing your distressed properties that you want to buy?
Sure. We still have relationships with HUD through the NSI program, which is part of the National Community Stabilization Trust. So we use government services entities. In a market like Baltimore, we get a lot from auctions. The competition in the auctions. Now, Philadelphia doesn't have a big auction presence. Baltimore does. But if you're not a cash buyer, it's very difficult to buy any sort of volume at the auctions. And to give you an example, one of the auction houses we have a very good relationship with, they move over 1,400 properties a year. Oh, wow. So, I mean, finding the supply is not an issue for us because, as Peter pointed out earlier, we're not buying that end product that could potentially go to a retail buyer. We're looking for the product that is pretty much a 98 to 99% total renovation. I mean, we want all new systems, new framing, everything, because we find from a maintenance standpoint, that helps us down the line. We have much fewer maintenance requests, a lot less deferred maintenance. So finding properties for us right now is not an issue. In a market like Baltimore, we'll cherry pick a market like New Jersey, because there's a tremendous demand there, more competition, taxes become an issue, and Philadelphia is kind of in between the two of those. The Philadelphia price points have moved up a bit. Baltimore fits our model better. Baltimore is kind of where Philadelphia was 10 years ago. So we're seeing a lot of the same trends that we saw with Philadelphia, and that makes us pretty comfortable.
Gotcha. Yeah, that makes sense. So you guys like to take it down to the studs, huh? You don't buy, mid 90s properties that have a few deferred maintenance, not too much. You want to just tear it down to the studs.
We'll buy the value add properties if they make sense. And a lot of times they have legacy tenants in there, so they become pipeline properties for us. We'll also buy foreclosures. That makes up a part of our portfolio. But again, we find the best value creation is when we can literally take it down to the brick walls reframe it, and it's almost like you're building a new house. And we do buy lots as well, so we do new construction. The more value we can add, the more equity we tend to create.
Yeah, that makes sense. When you're looking at neighborhoods within the specific metros that you're buying, is there any red flags? I mean, you already mentioned you like to do Section 8, and those are usually in a little bit rougher neighborhoods. Are there any red flags for those neighborhoods that, completely turn you off to the neighborhood?
Sure. I mean, we'll look at the crime statistics in areas. And then again, in cities like Baltimore and Philadelphia, at times it can be block by block. So we spend time in those areas asking questions, talking to local officials, try to figure out, where the problem areas are. And we'll avoid those. But we're also not afraid to kind of go into those transitional areas where we see more value, 3-5 years down the road.
Yep. That makes sense. All right. Well, hey, I took a peek at the clock. It looks like we are running it down. But before we move on to the next section, I would be remiss if I did not ask you guys about partnerships. Whenever we have two people come onto the podcast, I like to talk about partnerships because they are so important, so helpful to, make your career go a little bit quicker in the real estate sphere. So how'd you guys find each other? And then what are advice you could give to other people who are looking to create a partnership with somebody else, to make a successful partnership?
Sure. I'm sure everybody knows who's in real estate that real estate is a small world, and you tend to run into the same people over and over again. And it's actually our lead construction manager who introduced us probably about 5 years ago. And he was a friend of mine for a long time. I knew he was in the real estate business, and I had a deal that I was asking him about, and he said I should talk to Ron about it. And that was kind of how we met. And I'm coming from, a fundraising background and working in a company that was investing in second mortgages and transitioning into first. I really was at this time where I saw if you can capitalize and you can execute on the construction side of the business, you could be really successful. No matter what's going on in the market, you could be able to kind of, as long as you can read trends and shift with the market, if you can execute on the construction side of the business, then you'll be successful. So I really wanted to partner with somebody who had that background. When Brian introduced us, Ron definitely had that background, and we spent a lot of time together before we ever, did any deals together or partnered or set up our first funds and things like that. We just spent a lot of time driving around and getting to know each other and, kind of seeing how he works and his process and things like that. And it certainly has evolved over the years, and we probably spend a lot of time together now. So we get along, and that's a good part of it. You know what I mean? So I think being open and transparent with each other and having shared goals, but also he has a lot of strengths that I don't have, and I have strengths that he doesn't have, and so we kind of we work together well in that sense. So I think we're always learning from each other, and he probably wouldn't be doing something like this if I didn't force him on here. So
there you go.
That's true.
Yeah.
Well, I could take the second part of that for you if you want, about partnerships. I've been doing this again for 25 years. I've had good partnerships and I've had bad partnerships. And by no means am I suggesting this is how you go about forming a partnership. But if you can't look the person in the eye, shake their hand, and feel comfortable with that alone, that you're going to have a good partnership, then it's not worth it. I'm not saying that that's all you do. You certainly want to have things documented. But if you don't feel like you can shake that person's hand and you can trust them, then you should just walk away from it, because partnerships are tough, and if they're successful, they last a long time, and you're going to have your ups and downs. You're going to butt heads at times, but you got to feel like, that's got to be one of the people that you can trust most.
Yep. Yeah, I couldn't agree more. It's more of a gut reaction for me. I mean, you guys have got to have the same values, the same goals, but if you don't feel it in you, then it's not worth hitting your head against the wall too much. So, love to see it's working out for you guys. I always love to see partnerships work out well. I lied. I have one more question for you. I thought about this while we were talking. Construction, you guys do a lot of construction, and the construction side of real estate, I feel like you guys have a better feel for the economy, where it's headed, than most other people. So look into your crystal balls. Tell us, what do you see in terms of interest rates, in terms of the general economy, in the next, let's say, 2 years?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
So Peter will tell you this. I mean, just about whenever I'm doing anything on the computer, I always have CNBC on in the background. And I do watch what's going on in the markets very closely. It seems like things are easing. We had good data this week. A lot of people see the 10-year coming down. I'm cautiously optimistic that we're starting to trend in the right direction. I'd like to see a couple more quarters of the data moving in our favor before we can say, okay, the Fed's done tightening. A lot of people don't realize, a lot of people think that, the 30-year is just a mortgage interest rate is tied directly to the 10-year. I mean, it's loosely tied to it. It really has more to do with liquidity in the secondary markets, in the mortgage-backed security markets. So I think we need to see more of that as well to see any meaningful move in interest rates, but they are certainly moving in the right direction. We're still way underbuilt, and, interest rates play a role in how builders decide what they're going to be doing and how many new homes they're going to be building. So I think there's a lot of factors at play at the moment, but I am definitely cautiously optimistic that over the next 12 to 24 months, we'll see interest rates slowly coming down and then leveling off. I don't think you're going to see what we saw, 3 years ago.
No more
That's not
3%.
No, I mean, look, I came up in the late 90s. This interest rate environment's normal to me. I mean, this is what I was used to. We had artificially low rates for a long time.
Yeah, that seems to be the consensus among people that I ask that question. They all say that 6 to 7% should be what you expect. You shouldn't expect 3%, which that's good for me. So cautiously optimistic. I'm going to take that. I like it. Optimistic is in it, so we'll take it. All right, that does wrap up the first section. It is time to jump into the quick question round. Are you guys ready?
Fire them off.
Let's do it. All right. Starts with books or any form of education. Give me 2 recommendations, one for general life wisdom, one for real estate specific.
Peter, you can answer those. I don't remember the last time I read a book. I gotta be honest with you. I don't have time.
Yeah, right. It's been a little bit. I used to. That's like I should put that on my things to do in 2024, because this year with just launching a couple new funds and things like that, I haven't had the time to really read like I used to. But I would say, in general, I tend to like life wisdom and stuff like that. I mean, I'm Catholic, so I read a lot about, different saints and books on the rosary and things like that. So like, that's where like my life wisdom, kind of books and all has been. I've been reading a book called The City of God right now. So like when I need a break from real estate, that's where I will tend to go and just reading stories about saints. I just read little thing on Saint Maximilian Kolbe. So that was very interesting, and just the kind of dedication, that these people have in their lives, and they're on a totally different level. So that's one that I always go back to. And then, I look at real estate too, because my foundationally, I've been a fundraiser, and just raising capital for really good deals, and bringing investors into a really good strategy model and team. So Win Friends and Influence People, it's not a real estate specific book, but, I think a lot of real estate people, especially people who are good with spreadsheets and, construction and stuff like that, might not be the most personable of people, and be able to communicate effectively and create good relationships. So that's one that I always go back to. And I do try to pick that up a couple times a year and just kind of refresh myself. And because at the end of the day, your business is going to be fueled by relationships on all sides of the spectrum, whether it be capital, equity, or debt, for on the acquisition side, on the construction side, if you're working with GCs and subs and property managers and stuff like that. So that's one I always suggest to people in the business to get into.
Yeah. Dale Carnegie, How to Win Friends, Influence People. That is a classic. I think I read that in college, and I haven't read it since, but I remember I really enjoyed it when I did read it.
Yeah.
All right. Next question. This is for your younger self. So let's go back to the early Peter and the early Ron, who were just getting into real estate. Go back to them, look them in the eye, give them one piece of advice moving forward.
Peter's heard me answer this question probably 50 times, and it's the exact same answer. I should have kept doing what I was doing in the very beginning, which was simple. It was really what we do now. I was just doing it on a smaller scale. And if I had kept doing it, I wouldn't have had a lot of the troughs that I had in business, because going back to something you said earlier about the shiny objects, I definitely fell victim to that at times. And the funny thing was, it wasn't even real estate related. I was still running my real estate business, but I was directing resources to other things that I felt were exciting. And,
Crypto.
just stuff that I look back and say, what were you thinking? Just stay in your lane, focus on what you were focused on. It was working. It may have felt boring at the time, because I was always about the next deal. Like, I liked that juice, that adrenaline. And I would just tell my younger self, see the forest through the trees. Just, you don't have to get there tomorrow. It's not a sprint.
Yeah, I feel that is super, super pertinent and useful advice. And it's something that I'm still struggling with myself. So it's ignoring those shiny objects it's difficult, but it's definitely the way to go. Peter, do you want to answer that one too?
I would just say, always be building your personal brand. No matter what you're doing, always, document things that you're doing, take pictures of projects you're working on, deals, before and after shots. Always be, networking with people. And, I think it's one of those things, like, you do want to be careful, because like, this has kind of been a common theme of just the interview. You do have those people who, every time you see them at the event, they're doing something different. You know what I mean? So I do think you want to try to find yourself and stick to it. You know what I mean? Like, just pick something that, and take the time to research it and, due diligence it, all that kind of stuff, but then stick to it. It's not that you can't do other things in the future. But it takes a while to get something off the ground and to get the message out there, and then to perfect the message and all that kind of stuff. So just, I would say, always be building your personal brand and continuing to network with people. And, if you ever have to raise capital, it's the old adage, it's better to start 20 years ago than it is today. That kind of thing. So just always kind of be, even when you're not thinking about it, just keep it in the back of your mind, and, the time's going to come, and, you're going to wish you would have done those things. So that's, I think that would be my advice to myself.
Perfect. Yep. That is good advice. All right. Moving us on to the next question. And this is about the U.S. It's a big place, a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
I would probably say Baltimore. I think there's a ton of opportunity. I've heard people refer to it as like the like the gold rush shit. I mean, where you could still get a lot of really good deals and opportunities. And I think there's a with just places like there's a couple different cities and urban areas where people are, investors especially, could just be extremely intimidated because they maybe heard bad news stories over the years and things like that. And Baltimore certainly has its problems, but I think there's an amazing opportunity to find good deals there. And I think the city has some things going on where it could definitely revitalize over the years and change in positive ways. And more people like us who invest and revitalize areas and bring good units to market and all kind of go towards making it a better place. But I think sometimes I get excited when investors are turned off by certain areas, because I think that creates the opportunity. And I mean, when you start to hear on the podcast and reading the articles and things like that, that, and as a certain area is booming, chances are it's probably, you're probably missed the boat. You're probably too late. So I think Baltimore to me is very exciting. And Ron, I'd be interested to hear what you think.
No, I would agree. I mean, that's it's definitely probably the market I'm most excited about right now. If I had to say, there's two other markets outside of our area that I've definitely been keeping an eye on, and they're both in Alabama, Birmingham and Montgomery.
Yeah.
Birmingham and Montgomery.
Yeah.
So I think there's a lot of good things going on down there for our particular focus, the affordable and kind of middle housing markets. But I'm really excited about Baltimore. I think that there's definitely a revitalization movement happening. I think it's going to take some time, and I think we got in at the right time.
Nice. I'm just glad you guys didn't say Florida. I feel like every other person I have on this podcast has some city in Florida. So Baltimore, and then Montgomery and Birmingham. Great metros. All right. Next question is about finding the deal. It all starts with getting in contact with sellers. So what is your guys' favorite way to generate leads and find new deals?
Call the owner of the auction house. That's pretty much my go-to, and and working with the HUD relationship. But that the HUD relationship really is an up and down thing. It just depends. For a couple of months you'll get good deals, and then you won't see anything for the better part of a year. So right now, I would say probably my go-to is the auction houses.
Perfect.
I would just add to, I'd take it one step further. I mean, call the owner of the property. If you could find their contact information, don't be afraid to pick up the phone and call and have a conversation. You never know what's going to come out of it.
Yep, absolutely. All right, this is a good one for you too, because you guys are partners, and partners usually have opposite skill sets. So everyone is given a gift that they uniquely provide this world. What is each of your unique gifts? What's your Superman strength?
Oh, jeez.
Well, I'll kick it off. I mean, I think communications. I really pride myself on communicating with all facets of the business. And I mean, like I specifically, I work with the investors. So when people call me or text me or email me, I want to get back to them as quickly as I possibly can. You know what I mean? I've heard people over the years, like kind of mentors and things like that, just say in real estate in general, it doesn't matter what part of the business you're in. If you just pick up your phone, you're going to be successful. And that is so true. And that's advice that I would give to anybody, because so many people just don't do it. And, I when people email you, get back to them. Get back to them right away. Don't sit on it for a week or whatever. People text you, get back to them. And if you're busy or you got stuff going on or you're on a podcast or something like that, text them back and say, hey, I'm doing this. I'll get right back to you. I think people, really appreciate it. So it goes back to like the treat people the way you want to be treated. I'm one that I appreciate quick response and things like that. So I like to give that on to others. Ron, maybe I gave you enough time to come up with something there.
I mean, look, let me preface this by saying I really hate talking about myself. So I'm going to give you two things that I've been told consistently over, we'll call it the back half of my career. Strategic planning and strategy, and seeing the big picture. I mean, that would pretty much be the two. And I think seeing the big picture is not something that was always there, as referenced earlier. I think that was something that was developed over time, seeing different trends, different markets, and understanding things from a timeline standpoint. Because I do think that part of seeing the big picture has to do with your experience. So those would be the two things.
Perfect. All right, that leads us to the second to last question. This is about lessons learned. The biggest lessons that we learn usually come from deals that go sideways. So can you guys point out one specific deal that kind of went in a direction you didn't expect, and then give us the lesson that you learned from it?
I can tell you my first deal ever, which could have been a catastrophic disaster if I hadn't been 27 years old, is what really set me on the course that I ended up heading down. And it was, I bought a home. I ran around getting people to co-sign loans for me. I was going to just do a flip on a property. It was when I decided I wanted to get into real estate. And we were going to put a small addition on it. And I did next to no due diligence. And I found out when we went to get the addition that the house wasn't even because it was 300 years old. It wasn't even sitting in the building envelope. It was sitting outside the building envelope.
Oh, no.
So a house I was buying for $400,000 that I thought I would renovate and sell for about $800,000 turned into a new construction project that cost $1.7 million. That's how I got into new construction. I mean, talk about learning along the way. Took 18 months to finish, sold it while we were still framing it. We got it under contract, but we still had to pay to complete it. Again, had to scramble to get more people to co-sign loans for me. Broke dead even on the project, dead even after 18 months. So again, if I'm 50 now, if that happened today, it would have been a big problem. But I was 27 years old, still, sharing a house with other people. And I was able to get through it. And in the meantime, we started getting other jobs because people saw the quality of the work that we were putting out there. So that was could have been a disaster, turned into probably one of the biggest learning experiences of my life, and set me down, a career in real estate, construction, and investing.
Yeah, due diligence is so important. And when you miss, that's why, flips are difficult, because you never know what's behind the walls unless you tear them open. And so it's a good lesson. I'm glad it happened earlier in your career. Gave you a good lesson learned, and then you can bounce back from it. Had plenty of time. So awesome story. Thanks for sharing, Peter. Let's hear from you.
Wow. Well, I would say I've been fortunate to not have a lot of those stories, because my strategy has always been to surround myself with people who have kind of already been there and done that. And, instead of feeling the pain myself, I listened to other people's stories and took their advice and learned from their mistakes. So I don't really have any crazy stories like that, fortunately. So that's just like another suggestion I would give to people. Some people need to kind of feel the pain and learn it themselves. I've been fortunate to have partners where I could learn from their experience and then have them with me all parts of the deal. I did not have to run into those types of issues. So.
Perfect. All right. Well, knock on wood. Hopefully that continues.
Keep that going.
All right. That leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. What's the best way for people to reach out? And then what can they expect when they talk with you?
Sure. So gsprei.com is our website. They can go there. There's a ton of information on what we do, our strategy, our fund offerings. We have a podcast. They can find that on there. We do webinars and things like that. So gsprei.com is definitely a good place to get started. And then we have like a call schedule link on there as well, so people can always reach out. We're certainly happy to talk to anyone, whether they're active or they're passive. I think now is the time to be adding single family and especially workforce affordable housing to your portfolio. The metrics are a lot different than multifamily. Financing's different, demand's different. So I think a lot of people over the past couple of years, rightfully so, because the multifamily market's been wild, they have graduated up, and I think now is maybe the time where what's worked over the past couple of years probably won't work so much moving forward, or it's not going to work the same way it did, or as frequently as it did, or anything like that. So I think people should definitely take a hard look at single family and the demand in that space, and we're happy to talk to anybody who wants to talk about that and pick our brains on it. So
perfect. All right, I will put that link in the show notes, gsprei.com. If you guys want to reach out, just click the little more in the description. It'll pull down that full description, and in there you can find the links. Awesome. Well, Peter, Ron, thank you guys very much for hopping on the show.
Gabe, thanks for having us.
Thanks for having us. It was great being here.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to support the show, all we ask is give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at Gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.